I'm Dr. Kavitha Yadav. The session would be regarding functions of future markets. Let's see what are the functions of future markets. See, this futures market serves the need of individuals and groups who may be active traders or passive traders, risk averse or risk takers, and or also profit makers. Functions of future market are of three types. They are price discovery, speculation, and hedging. So we will see how future markets carry on these three functions. First, it is price discovery. See, future prices might be treated as a consensus forecast by the market regarding future prices for specific commodities. This helps to forecast the price in future. So the advantage of price forecast is based on future price, which depends on three factors, namely to avoid errors in future market, performance must be satisfactory, and to plan for the future and to generate wealth. There is a need for information about future spot prices. So here simply it means in future prices you have to foresee or you have to forecast what would be the future price for that underlying asset. Okay, based on that you will be getting into the futures contract. So since you foresee the future, if you have to make the best advantage or if you have to get the best of foreseeing the future, you have to mainly depend upon three factors. That is, you have to avoid errors in the future market and you have to see the underlying assets performance is satisfactory and you have to plan for your future. By keeping these factors in mind, you can generate wealth if you get right information about the future prices of your underlying assets. So future price of the underlying asset will be foreseen in futures contract. So therefore we can tell price discovery takes place in futures contracts. Then the second function is there is speculation. Okay, speculation is a spillover of future trading that can provide comparatively less risk adverse investor with the ability to enhance their percentage returns. See, future is uncertain, and with little bit of speculation itself, futures contract will be undertaken. Sometimes you may predict the prices of the underlying assets may go up, and you may get into buy future contract. Sometimes you may predict the prices of the underlying asset may go down and you will go for sell future contract. So speculation will be there in different types of futures contract, and if you have to classify them, you have got something called as scalpers. See, they make an attempt for profit on short-term pressures to buy and sell by reading other traders and transactions in the futures market. Okay, to make short-term gains through short-term pressures, the scalpers will see that future contracts are undertaken and short-term pressures are um, in a way converted into short-term profits. Then you have got day traders. They hold the future position for few hours. Then they open and close to the future position within the same trading day. For few hours they hold, and then the same trading day they will close the futures transaction, and they will see that there will be enough of gains that they make through these type of transactions. Then you have got position traders. They have longer horizons, holding positions overnight, say for few months. Okay, these position traders hold the transactions, future transactions for longer period of time. They may be outright position holder. See, these outline outright position holder take their position in the futures market, relying on their belief on the future of their market. They are very certain about the future of the market. The main drawback is that it offers a chance for very large gains if it is correct, but it carries risk as well. So they are very confirmed that there will be some changes according to their prediction in the futures market, and they go on holding the transaction. If it is right, then they will make profits. If not, they have to face losses. Then you've got spread position holder. They focus on the relative price movements between two or more commodities. They keep correlating between the prices fluctuation between two or more commodities, and then decide in which commodities future contracts have to be got into. Then you have got hedging. In order to reduce the risk in the spot positions, the futures trader is set to establish a hedge which are of different types. See, hedge is a strategy to mitigate the risk in the transactions. Okay, there are different types of hedges. First one, long hedge or anticipatory hedge. See, an investor protects against adverse price movements of an asset will be purchased in the future. See, whenever there is lot of adverse price fluctuations, then the investor will invest in long hedge and protect himself against the adverse price movements. Then you have got short hedge. An owner investor already owns a spot asset and engage in a trade to sell its associated future contract. Here, the investor would have that asset, but he wants to sell that asset because he is entered to protect against, he enters that contract to protect against a declining asset. So whenever an investor feels the asset which he owns may decline in future, then he will go for short hedge and protect himself against the declining prices of the asset. Then you have got cross hedge. Cross hedge is a futures contract strategy or a financial strategy to offset or minimize the loss from one asset from the profits of the other assets. Here in cross hedge, they purchase two different assets. It might be security or commodity also in the futures market with a positive correlation in the movement of their prices. So they see that they buy two types of commodities in such a way that there should be positive correlation between the prices of the commodity. If one price goes up, and the other price of the commodity goes low, then the investor may incur profits in one futures transaction and may enter loss in another futures transaction. But the profit from one commodity will be offsetting the loss from another commodity. So when such strategy has to be used, they will go for cross hedge. So these are the different types of functions undertaken by futures market. Thank you.